Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. So happy you joined us here in what's been a tumultuous couple of weeks in the market. We're thankful for the opportunity we've had with those of you so far at Thirdlies and those for the remainder of this week. And for those of you who didn't have a chance to get out, we'll do the best we can here. We always do each and every week to give you kind of the highlights of what we find important in the market. So I got quite a bit this week. We're going to talk about our risk barometer, what that means for portfolios. And then Andrew's going to give you an update on where this market has landed in very technical varieties and kind of what the status of the market is at this point. So we'll talk about the risk barometer, but philosophically, I think it's important just to take a step back and what that means to us. First of all, our philosophy is that for the most part, we view markets as going to have a period of corrections, and corrections are going to happen. Just call it about once every year. They are normal. They're part of investing, and we're going to have to accept them, so to say, as part of our investment journey. However, once you go beyond a correction, say a mild decline in stocks, we feel we have a duty to mitigate that risk for longer, protracted, long-term downturns in the market, and that's where our risk barometer steps into play. So philosophically, you will never see us. We preach this over the decades that we're never going to be all in or all out of markets. Movements can often happen so fast, up and down, that you can't really fully, time every piece of the market. But that said, we do want to mitigate against the trends the best that we can. In our risk barometer, we dedicate a portion of our assets in our portfolios to be managed by our risk barometer. In one set, when we're on offense, we will have an offensive basket of ETFs. When we're on defense, we have the opposite. We'll have a defensive basket. What you often won't see is tons of cash in all of our portfolios. We find that's not necessarily the best long-term venture. But just because the money's fully invested doesn't mean it's going to be always an offensive or high beta, high volatility investments. Often in defensive periods, you may see your accounts still fully, for the most part, invested, but what's underneath the hood can be very different. And often those ETFs can, inside of them, have either high levels of cash or they could have other defensive instruments. So we really have to look under the hood of what we actually own. But to comprise our risk barometer, we've got three different buckets of analysis that we look at. You've got our fixed income. That's mainly going to be looking at credit conditions in the economy. Are banks getting looser with their lending? Is credit flowing freely or is it contracting? Then we'll look at money flow. This is, for those of you who've been around for a long time, the big boats. How are the institutional investors behaving compared to their retail counterparts? And we're looking for divergences. And then lastly, we'll look at the trends of the market and very objectively put them in a basket and let us guide whether to be offensive or defense. So coming into April, we had this shift in our risk barometer. So really, thankfully, before the bulk of the recent turmoil, we moved to a more defensive posture. And again, as I started this, that doesn't mean a whole lot of cash, and it doesn't mean going all the way out. It means making enough adjustments so that we can soften the blow if this were to materialize into a full-blown, extended, protracted bear market. And on this next slide, you can see kind of the history of our risk barometer. We've got it marked in green for periods where we were on offense, and then you can see the red dots where you have the defensive basket in play. So here recently, the last couple of weekly readings have been red. This is a weekly indicator, so as data comes in, if we see let's say those big boats, this institutional activity, if they begin to get offensive and buy and can change the trends the other direction, you will see us get back into an offensive posture. So that's the risk barometer. I'll have Andrew now turn it over to him to give you a high speed frequency look at these markets.
Thank you, Adam. So a lot's taken place over the last couple of weeks. We've been talking throughout through 2025 and at the end of last year that we were really seeing a heavy reliance on those Mag 7 stocks, really starting to see very few stocks were confirming the uptrend. We talked about how fast that we saw the market decline just 5%. Talked about a paper that I'd written looking at the market and how fast it can decline in such a short period of time and how that can lead to more tumultuous market conditions. And now, fast forward to today, we've seen the market drop quite a bit fairly quickly. There's been a lot of different reasons for that. We have the tariffs. We have the fact that we have such overweight towards just a handful of stocks. We have all these different market conditions that set us up to produce this type of volatility. And with that, we have something that's fairly unique. And so I want to look at a couple different charts to show you just a very small view into what we've been looking at on the allocation team. And the first is how unique this 10% with the first 10% that we moved occurred very quickly. It took us just 6 days to fall by 10%. Something that I've plotted a blue dot when it's happened before, and you can see it hasn't happened very often. It happened near the low during the bear market in 2022, of course, during the COVID crash in 2020, many times, unfortunately, during the great financial crisis. But really, outside of those conditions, it's happened just 3 times outside of really a crisis crash type market since the great financial crisis. And typically, when we see the market decline this fast, it's been at fairly opportune times outside of the great financial crisis. Even during the dot-com period back in the 2000s, we would see some pretty strong bounce backs in the market after we saw a very large decline happen, 10% decline happen in just a matter of a little over a week. Now let's look at the next chart here. And now we're looking at one of my favorite areas of the market, looking at breadth. Whenever we talk about the S&P 500, the NASDAQ 100, the Dow, it's a makeup of individual stocks, and we want to know how those individual stocks are performing. Now, with this recent decline, we've seen actually half of the S&P 500 has fallen by hit a 6-month low. Stocks are hitting multi-week lows. And this is something, again, that we don't see very often. In fact, we never saw a single day of over the half the market hitting a 6-month low during the last bear market in 2022. Again, we saw it during the COVID crash. We saw it during the mini bear market in 2018. And then again, several times during the great financial crisis. But when we start seeing these types of market conditions where we see a lot of stocks declining all at once, hitting half a year lows, and when we have over half the market doing so, again, it's been happening at fairly opportune times for the market to go higher. All right, let's look at the next chart. The next one I have here is looking at what can happen after we see these bounces and recognize that the market can be very volatile. When we start seeing the market decline, starting hitting 10, 15, 20% drawdowns, that what can happen after that can be some fairly prominent snapbacks in the market, some of these counter trend rallies. I've highlighted several over the last kind of the major market declines. Again, in 2022, the last bear market we saw 2 fairly big snapback rallies of 10% and 17%. 2018, we saw the market bounce almost 7%. Look back during the great financial crisis, we actually had a rally of 25% during that downturn. All this to say that we can start seeing the market move not in a straight line, but in these big counter trend rallies, and really trying to understand what the market's doing as it tries to adjust to new buying and selling pressure. And so as we move forward, we're going to continue to see the market move in big swings. That's very normal. And so we want to understand the type of market that we're in, and these types of markets that they can see big moves to the upside and big moves to the downside while we try to find price discovery and kind of iron out what the next trend will be in this market.
Yeah, thank you, Andrew. And it's we've seen a number of these higher volatility environments, throughout our 25 years plus in business, and it won't be the last here. But I could tell you, very few of them ended very quickly. That's not zero, but very few of them. And one thing is for sure, we'll be here every step of the way using our tools, monitoring these investments and making adjustments on your behalf as those indications and those indicators lead us to make them. So thank you again. We sure appreciate your time. If we can be of service, please don't hesitate to reach out. If you have any question at all, we know you may have lots of them. Please don't hesitate to get in contact with us. We're happy to walk through these periods with you. 800-928-4001 is the phone number, or you can scan the QR code and do so electronically. Thank you and have a great weekend.